Hi Surendra, morning, happy morning. So I welcome you to this live session. Hi Monish, happy morning. So today we will discuss model test paper 2. So early in the morning, let us start very fresh. First we will do MCQs. After doing MCQs, then we will discuss descriptive questions. I hope my voice is audible clearly. Please confirm me once. Am I audible clearly? Falcon Limited of Country X is an associated enterprise of Max Inc. of USA. Falcon Limited has a branch in India since 2010. So there are two countries, there are two companies. Falcon Limited, this is in Country X, and there is Max Inc. This is there in USA. Falcon Limited has a branch in India since 2010. It was selling goods to Indian customers by importing from various countries, besides sale in India of goods manufactured by it in country X. So, what do you mean by this? Falcon Limited has a branch in India. What this branch will do? It will import goods from parent company. It will also import goods from outsiders. Okay, whatever the goods imported are there, those goods are being sold in India. The adjusted total income of Indian branch of Falcon Limited for the year ended 31st March 2025 is 80 lakhs. So how much is adjusted total income? 80 lakhs. The branch incurred 12 lakhs by way of executive and general administrative expenditure during financial year. So how much is branch actual expenditure? 12 lakhs. Next. The head office has allocated 18 lakhs as the branch share of head office expenditure. So how much is head office allocation? Head office allocation is 18 lakhs. In PGBP there is one concept. Especially in this case, whatever the expenditure allocated by head office to branch is there, total expenditure is not allowed as deduction. 5% of actual 5% of adjusted total income or actual branch expenditure, whichever is lower will only be allowed as deduction. Okay, now as branch share of expenditure including expenditure of 12 lakhs. Now the entire point is head office allocated 18 lakh rupees, but 18 lakh rupees is not allowed as deduction. How much is allowed as deduction? Allowed is equal to 5% of adjusted total income or actual branch expenditure, whichever is lower. How much is adjusted total income? 80 lakhs. 80 lakhs into 5% or actual expenditure 12 lakhs, whichever is lower. 80 into 5%, how much? 4 lakhs or 12 lakhs, whichever is lower means 4 lakhs will be allowed as. So whatever the expenditure allocated by head office is there, total expenditure allocated by head office will not be allowed as section. Next, a survey under section 133A A survey under section 133A of the Act was conducted in its branch premises in January 2025 and undisclosed assets of 90 lakhs were found. Assessment for assessment year 24-25 was completed by making addition to entire undisclosed asset of 90 lakhs. Hi Varun, good morning. The SSC preferred appeal before CIT appeals who gave complete relief to the SSC. The income tax department wants to file appeal before ITAT. So what happened? Survey conducted, undisclosed assets 90 lakhs were found. Then assessment was completed. Whatever 90 lakhs undisclosed assets are there, with regard to that 90 lakhs, assessment order was passed. Now, SSC got aggrieved. He filed appeal against department in CIT appeals. CIT appeals gave judgment in favor of the SSC. Now, whenever CIT appeals gave judgment in favor of the SSC, then what income tax department will do? Income tax department will file at income tax appellate tribunal. To file appeal at income tax appellate tribunal, certain limits are there. If total income is up to 60 lakh rupees, they can file appeal to ITAT. If it is more than 2 crore rupees, then they can file appeal at High Court. If it is more than 5 crores, then they can appeal at Supreme Court. So for filing appeal at ITAT, High Court, Supreme Court, CBDT released guidelines only if whatever the income is there, if it is more than 60 lakh rupees, then only appeal can be filed at ITAT. Here, how much is undisclosed assets? Undisclosed assets are 90 lakhs, which is more than 60 lakhs. So department can file appeal at ITAT. Okay. Next, T Private Limited, an Indian company, a wholly owned subsidiary of Falcon Limited, paid 50 lakhs to XYZ Inc. of Country M as fees for technical services. Services were rendered by employees of branch XYZ Inc. in India. There is no DTAA between India and Country M. T Private Limited has entered into certain international transactions during 23-24 and 24-25. T Private Limited invested in SS Private Limited of Country Y and received dividend of 550 lakhs during financial year 24-25. It declared and distributed interim dividend of 250 lakhs on 10th November. See, you know dividend, right? Whenever one company receives dividend from another company, total dividend is not taxable. Out of total dividend received, whatever the dividend it is distributed to shareholders is there, that will be reduced and only balance dividend is taxable. Correct? So here how much is dividend received? Dividend received is 550 lakhs. Out of dividend received, how much was distributed? 250 lakhs was distributed on or before 10th November 2024. See, whenever intercorporate dividend is received, the dividend must be distributed to shareholders at least 1 month before ITR due date. Generally, in case of company, ITR due date is 31st October. At least 1 month before 31st October, the dividend should be distributed. So, he declared interim dividend of 10th November 2024. In current year only interim dividend was received and final dividend 230 lakhs was declared on 12th November. 12th November means what? After ITR due date. Na? So this should not be reduced. 230 lakhs should not be reduced. 250 lakhs can be reduced. So how much is intercorporate dividend received? Intercorporate dividend received is equal to 550 lakhs. Out of 550 lakhs, how much is distributed to shareholders? 250 lakhs is distributed to shareholders before ITR due date. 230 lakhs is distributed after ITR due date. So that will not be allowed as deduction. 250 lakhs as it is distributed before ITR due date, only that will be allowed as deduction. So how much dividend is taxable? Dividend taxable is equal to 300. Okay. Let us solve this. How much tax to be deductible at source by T Private Limited on the fees for technical services paid to XYZ Inc. Here, T Private Limited paid fees for technical services 50 lakhs. Na? What is the amount of TDS that is required to be deducted? See, if fees for technical services is as per the agreement approved by government, tax rate is 20%. Here, fees for technical services is not approved by government, so TDS will be deducted at rates in force under section 195. Okay, so how much? 50 lakhs. Falcon Limited is a foreign company, correct? Now, how much is the tax rate? 30%. Hold on. I think first one answer is C. 18 lakh 20,000. 50 lakhs into 30%. See, 50 lakhs into 30%, okay. Along with that, surcharge is applicable, na? 50 lakhs, Falcon Limited. Sorry. Foreign company tax rate is 35%, na? 50 lakhs into 35% plus 4%. Yes, perfect. 50 lakhs into 35%. Here 20% concessional tax rate is not applicable. The reason is fees for technical services agreement is not approved by government. So 50 lakhs into 35% plus 4% HEC. 18 lakh 20,000. Are you able to understand? So here Indian company which is wholly owned subsidiary of Falcon Limited paid 50 lakhs to XYZ INC of Country M as fees for technical services. Next, how much of dividend received by T Private Limited would be liable to tax for assessment year 25-26? We already discussed. 550 lakhs intercorporate dividend is received. Total is not taxable. It is redistributed to shareholders. Now, how much is redistributed? 250 lakhs before 1 month before ITR due date. So, 300 lakhs is taxable. I think that is the answer. 2 is C. Correct. Next. How much of head office expenditure can be claimed by Indian branch? We have did na 5% of adjusted total income or actual branch expenditure, whichever is lower. How much? 4 lakh rupees. So this is allowed. Can income tax department prefer appeal before ITAT in respect of complete relief obtained by Falcon Limited? Yes, because tax liability is more than 60 lakh rupees. We have discussed. See, there was one circular which came in 24-25. Before that circular, limits are ITAT 50 lakhs, High Court 1 crore, Supreme Court 2 crores. But I think it came in September 2024. As per that circular, limits are revised. If department wants to file appeal to ITAT, tax liability should be more than 60 lakhs. If department wants to file appeal before High Court, tax liability should be more than 2 crores. If department wants to file appeal before Supreme Court, tax liability should be more than 5 crores. Okay. So here department wants to file appeal before ITAT. For ITAT, what is the limit? The tax liability should be more than 60 lakhs, correct? So 3A, 4C. Yes, 3 answer is correct A, 4 answer is correct. Case scenario 2. Mr. Abhay, a resident Indian, is in retail business in Delhi and his turnover for financial year 23-24 was 9.8 crores. He regularly purchases goods from another resident, Mr. Kunal, a wholesaler in Delhi. So there are two persons. Kunal is there, Abhay is there. Who is seller? Kunal is seller. Who is buyer? Abhay is buyer. He regularly purchases goods from another resident, Kunal. Aggregate payments made by Abhay to Kunal during financial year 24-25 was 90 lakhs. So, how much are sales done? Sales done are 90 lakhs. So, payment made is also like sales made are 90 lakhs. That means sales made are more than 50 lakh rupees. Here, TCS provisions will get attracted. Kunal's turnover was 13.5 crores. Abhay turnover was 9.8 crores. So, in preceding financial year, Abhay turnover is 9.8 crores, which is less than 10 crores. However, in preceding financial year, Kunal's turnover is 13.5 crores, which is more than 10 crores. In case of seller, in preceding financial year, if turnover is more than 10 crore rupees, okay, and if value of goods sold are more than 50 lakh rupees, then the seller is required to collect TCS under section 206C 1H. Are you able to understand? And TCS will be collected on amount in excess of 50 lakh rupees. In excess of 50 lakh rupees. What is the rate of TCS? 0.1% if PAN is given. If PAN is not given, then rate of TCS will be 1%. Correct? And TCS will be collected not on entire transaction. TCS will be collected on transaction amount in excess of 50 lakh rupees. Are you able to understand? Kunal remitted 6,50,000 on 28th March 2025 out of his personal savings through Canara Bank Delhi branch, which is an authorized dealer under LRS, Liberalized Remittance Scheme of RBI, as a gift to his elder brother residing in Dubai on occasion of his 60th birthday. See, if any amount is remitted outside India, TCS is required to be collected under section 206C 1G. But threshold limit is there. If amount remitted outside India is up to 7 lakh rupees, no TCS is required to be collected. Here how much amount is remitted? 6,50,000, which is less than 7 lakhs. So no TCS under section 206C 1G. Okay. Mr. Kunal paid 8,80,000 on 1st November 2024 to World Travels for a holiday package to a Singapore for a week with his family comprising of his wife and two children, being twins aged 19 years in the last week of November. See, whenever you are making payment for overseas tour program package, on such payment TCS is required to be collected. What is the rate of TCS? Overseas tour program package. If amount paid to tour operator, if it is up to 7 lakhs, rate of TCS is 5%. If it is more than 7 lakhs, rate of TCS is 20%, and this TCS is required to be collected at slab rates. Okay. Now how much payment was made? 8,80,000. Out of 8,80,000 on 7 lakhs, TCS rate is 5%. Balance 1,80,000. On 1,80,000, TCS rate is 20%. So 7 lakh into 5%, how much? 35,000 plus 1,80,000 into 20%, how much? 36,000. So 36,000 plus 35,000, 71,000 is the TCS that is required to be collected under section 206C 1G. Okay. See, this part we will see little later. Come to the questions. Question number 5. Are provisions of TDS TCS under Income Tax Act attracted in respect of purchase of sale transaction between Abhay and Kunal? Yes, they are applicable. Kunal is required to collect TCS. Correct. Here, Kunal is required to collect TCS under section 206C 1H. Those provisions are applicable. So the answer is Kunal has to collect TCS at the rate of 0.1%. This is the answer. In case of failure to furnish PAN by the deductee or collectee as required based on the answer to question 5 above, what would be the applicable rate of TDS or TCS? See, seller is required to collect TCS provided if PAN number is given. If PAN number is not given, then TCS will be collected at the rate of 1%. Are you able to understand? PAN given 0.1%. If PAN is not given, TCS rate is 1%. Next. Is World Travels required to collect TCS at source on receipt of 8,80,000 from Kunal for holiday package to Singapore? Yes. We did the calculation na 71,000. Up to 7 lakh rupees TCS rate is 5%. Above 7 lakh rupees TCS rate is 20%. We have discussed, correct? Next, remaining part is there. Let us read this part. He took an education loan of 13 lakhs on 1st February 2025 from Canara Bank Delhi branch for his son's 2-year Master of Public Administration program in UWA University, Australia, and remitted the said amount through same bank under LRS. For his daughter's research program in PSL Research University, he remitted 12 lakhs on 15th February 2025 out of his personal savings. See, for the purpose of education, if any amount is remitted outside India, TCS will be collected at the rate of 5% if remittance is more than 7 lakh rupees. However, if you take education loan, from education loan, if you make the remittance, then TCS rate is not 5%, TCS rate is 0.5%. This concept we have discussed when I am revising TDS and TCS concept. Okay, TDS and TCS lecture. Now, 13 lakhs was remitted out of education loan na. As it is remitted out of education loan, rate of TCS will be 0.5%. Now, 12 lakhs is remitted to daughter out of personal savings. It is not education loan. So, the rate of TCS will be 5%. Very simple. You took education loan, sent money outside India. Rate of TCS 0.5%. Out of your own money, you sent money outside India for the purpose of education. Rate of TCS is 5%. Okay. Now, let us read. What is the amount of tax to be collected from Mr. Kunal in respect of remittance of amounts overseas for his sons and daughters' education? So, on sons, how much is remitted for son? 13 lakh rupees. See, amount of remittance. Whatever the remittances that you do for education, health, or for gift, all remittances together up to 7 lakhs, no TCS. All transactions together, if it is more than 7 lakhs, then in excess of 7 lakhs, TCS is required to be collected. Here, first remittance was on first remittance was on 1st November 2024. Second remittance was on 1st February 2025. Second remittance was on 1st February 2025. Third remittance was on 28th March 2025. Am I correct or not? So, when first remittance was made, 1st February 2025, 13 lakh rupees. So, out of 13 lakh rupees, 7 lakh rupees, no TCS. Whatever balance 6 lakh rupees is there, on that TCS will be collected at the rate of 0.5% as it is remitted out of education loan. So on 6 lakh rupees TCS will be collected at the rate of 0.5%. 6 lakhs 0.5%, and on 12 lakhs TCS will be collected at the rate of 5%. Let us see answer for question 8D. You can check answer for question 8 is okay. Next, are TCS provisions attracted in respect of remittance of gift to brother? See, gift to brother is third transaction na. Gift to brother is third transaction. Already up to 7 lakh rupees exemption from TCS is already taken. So on this, yeah, this is gift to brother is third transaction na. So obviously TCS is applicable, because for already for education loan we took exemption of 7 lakh rupees for first transaction. The third transaction 6.5 lakhs, which is after two transactions. So on this TCS is applicable. What I said, for education purpose, for health purpose, if you remit money outside India, rate of TCS is 5%. Other than education and health, if you remit money outside India, rate of TCS will be 20%. So on the 6,50,000 rate of TCS is 20%. So 6,50,000 into 20%, how much? 1,30,000. This is the answer. Case scenario 3, Flax Private Limited availed online digital advertisement service. See, whenever online digital advertisement services are received, you need to remember the concept equalization levy. Okay. Provided by Marshall Inc. of USA in March 2025, it paid 10 lakhs, and the amount outstanding as on 31st March 2025 was 2 lakh rupees for the said online digital advertisement services. Marshall Inc. had undertaken technical services from consultant of USA for the purpose of expansion. See, this is different concept. This is different concept. See, whenever a company in India makes payment for online advertisement services, if the amount of payment is more than 1 lakh rupees, here amount paid is more than 1 lakh rupees. So this company is required to reduce equalization levy at the rate of 6%. And equalization levy is required to be deducted on accrual basis, not cash basis. You can see, like already 10 lakhs was paid and 2 lakhs is payable. That means how much is accrued? 10 lakhs already paid plus 2 lakhs accrued. So equalization levy at the rate of 6% is required to be deducted on 12 lakh rupees. Are you able to understand? Next, Marshall Inc. had taken technical services from a consultant of USA for the purpose of expansion of one of its business units engaged in toys manufacturing in India. The consultant gave his report in USA and no part of services were provided in India. The country does not have DTAA. See, Marshall Inc. is in USA. Marshall Inc. It is in USA. Consultant. Consultant is also in USA. See, both are non-residents. Consultant is providing services to Marshall Limited. It is income to consultant. Whatever this income to consultant is there, will it be taxable in India? It will not be taxable in India. But why consultant is providing services? Consultant is providing services with regard to business units in India. With regard to any business in India, if any technical services are provided and fees for technical services is received, that fees for technical services will be considered as deemed to be accrued or raised in India. So here section 9 is applicable and this income will be considered as deemed to be accrued to consultant. Are you able to understand? As it is deemed to be accrued to consultant, it is taxable to consultant. So question number 1, whether equalization levy is required to be deducted? Yes. 6% on 12 lakhs. How much? 12 lakh into 6%, 72,000. Equalization level of levy of 72,000 is to be deducted by Flax Private Limited. Would Flax Private Limited be liable to pay any interest and or penalty if amount of equalization levy was remitted on 20th June? See, whatever equalization levy that is deducted, it is to be remitted on or before 7th of next month. Whatever TDS due dates are there, same due dates will also apply for equalization levy. So, it is to be deducted on or before 7th of next month. But here he is saying it was deducted on 20th June 2025. If you do not deduct equalization levy on time, if you do not pay equalization levy on time, then you are required to pay interest at the rate of 1% per month. You are also required to pay penalty. So here how much is interest? Yeah, here it would be liable to pay both interest and penalty. Interest will be 1%, penalty is equal to amount of equalization levy. Next, would Marshall Inc. require to deduct tax at source on amount paid to consultant of USA? Yes. Tax is required to be deducted. What is the tax rate? See, fees for technical services approved by government, tax rate is 20%. If it is not approved by government, tax rate is 30% plus, like rates in force. Whatever the tax rate applicable to non-resident is there, we will take that tax rate. So tax rate applicable for non-resident, here consultant is individual, na? So 30% plus 4% HEC as per section 195 will be deducted. Let us check answer of 12. Answer of 12 is B. Let us check. Yeah, perfect. Whenever fees for technical services is approved by government, then only concessional tax rate of 20% is applicable. Next, Swastik is a charitable trust registered under section 12AB with its main objectives falling under the residuary clause, any other object of general public utility. During 24-25, it received 90 lakhs as voluntary contributions. So, how much voluntary contributions received? 90 lakhs. Trust also borrowed 45 lakhs on 14th August 2025 from Axis Bank to purchase land for construction of an office building from where it can carry out its function. The trust repaid principal of 10 lakh rupees to Axis Bank as on 31st March 2025. See, in trust taxation we have discussed, whenever any loan is taken by trust, it is not treated as applied. Whenever loan taken is repaid, at the time of repayment, whatever the amount repaid is there, it will be treated as applied. Am I correct? So 45 lakhs loan taken, 45 lakhs is not treated as applied. How much is repaid? 10 lakhs is repaid. Only 10 lakhs will be treated as applied. The trust has donated to another trust registered under section 12AB with main object of providing education to poor 14 lakhs out of its current year income. What would be the application of the trust for previous year 24-25? Excluding unconditional accumulation of 15%. See, how much will be considered as applied? Whatever 10 lakhs repaid is there, that will be treated as applied. Along with that, 14 lakhs was donation given to another trust. Correct? So, if any donation is given to another trust, it should not be corpus donation. Here he said it is not corpus donation. Not a corpus donation, that was said. So how much donation was given? 14 lakh rupees. Whether total 14 lakhs is treated as applied? No. Out of donation given to another trust registered under section 12AB, 85% will only be treated as applied. So how much? 14 lakhs donation given into 85%. 14 lakhs into 85%, 11 lakh 90,000. The total 21.9 lakhs. This will be treated as. Which of the following deduction or exemption or set off of losses are allowable while computing income under respective head of income and total income of individual as per section 115 BAC? See, under default tax rates, certain benefits are not allowed. In this, he is asking what are the benefits allowed under section 115 BAC. Interest on housing loan in respect of self-occupied property. For self-occupied property, maximum interest allowed under house property is 2 lakhs or 30,000. Even the 2 lakhs or 30,000 is not allowed if SSE is paying taxes under default tax rate. So this is not allowed. Deduction for interest on housing loan in respect of let out property. For let out property, whatever the interest is there, such interest will be allowed as deduction. Okay. So even under default tax rates also for let out property, whatever the interest is there, total interest you can claim as deduction. Next, exemption in respect of agricultural income. See, agricultural income is exempt both under default tax rates as well as under optional tax rates. That benefit is available. Exemption in respect of minor child income included in income of parent. Whenever you club minor's income in the hands of parents, 1500 exemption is available, but that 1500 exemption is not available if SSE is paying taxes under default tax rates. This exemption is not available. Next, set off of losses under house property against income under any other head. See, if SSE is paying taxes under default tax rates, inter-head set-off of loss from house property is not allowed. Generally, loss from house property is eligible for inter-head set-off up to 2 lakhs and it can be carried forward to subsequent years under optional tax rates. But under default tax rates, whatever loss from house property is there, it is not eligible for inter-head set-off. It also cannot be carried forward to subsequent years. So this cannot be carried forward. Next, standard deduction is available under salaries. Under default tax rate, standard deduction available is 75,000. Under optional tax rate, standard deduction available is 50,000. Do you remember? So this is available. So how many benefits are available? 2, 3 and 6. So A is the answer. Surendra, are you there? Are you following me? Next. Question number 15. Rahul, a resident Indian, purchased units in ABC Real Estate Investment Trust on 1st April 2024. So Rahul is there. ABC REIT is there, Real Estate Investment Trust. And received dividend income from TL Limited being a SPV. So here SPV is TL Limited. It is SPV. From SPV, REIT received dividend income. Next, the record date of ABC REIT is 1st June 2024 and it distributed dividend to unit holders. See, whatever the dividend is there, the dividend is passed on to unit holders. So pass through status, it enjoys pass through status now. So dividend is passed on to Mr. Rahul. Now, if SPV pays taxes at normal tax rates, 25% or 30%, dividend is exempt in hands of business trust. Dividend is also exempt in the hands of unit holder. However, if SPV is paying taxes at concessional tax rates under section 115 BAA, then dividend is exempt in the hands of business trust. Such dividend is taxable in the hands of unit holder. Correct? Now let us see the question. Would dividend stripping provisions be attracted if Rahul sells the units held by him at a loss in January 2025? Is ABC REIT required to deduct tax at source on dividend component of income received from SPV and distributed to Rahul? Yes, TDS is required to be deducted. Hmm. Here see SPV opted for section 115 BAA. Whenever special purpose vehicle opts for provisions of section 115 BAA, in that case, it is exempt in the hands of business trust, taxable in the hands of unit holder. As it is taxable in the hands of unit holder, TDS is required to be deducted. If he is non-resident, rate of TDS will be 10%. If he is resident, then also rate of TDS is 10%. So dividend stripping provisions here, it will not get attracted. Okay, that is for normal dividend. Here dividend is received from SPV and passed on to unit holder. So here Rahul is resident Indian na. So rate of TDS is 10%. So dividend stripping provisions would not be attracted. REIT is required to deduct tax at 10%. So answer for 15 is B. Anyhow, let us check once. So 15 answer is B. Okay. So with this, we are done with MCQs. Did you all understand MCQs of model test paper 2? See how much depth he is asking MCQs. That's why you need to listen to all model test papers, mock test papers and RTPs. Right away, if you go to examination, you will fumble in the examination. Okay, so when we do these many model test papers, these many mock test papers, you will get accustomed to twists that are given by ICI. In every problem we are seeing some new twist, new point. So whenever we do these many MCQs, you can go to examination very confidently. Okay, because you had experience of doing all these model test papers and mock test papers, you can go confidently. Without doing all this, if you go to examination, you cannot anticipate how ICA is going to ask MCQs. You cannot anticipate how case scenario based questions will be asked. So everything will be new in the examination. High chances you will get less marks in the examination. This is the reason why many students are failing. Okay, ICA is giving enough resources, but student will not practice enough resources. Directly he will go to examination. How can you counter professional exam, that too at final level, without doing practice? You need to practice all model test papers, mock test papers and RTPs. Then only you can go to examination, then only you will feel confident. I am telling you, how you write the examination, that is secondary. How confidently you went to the examination, that determines whether you will pass or fail. It is not the question paper, it is not the answers that you write in the examination that will determine before examination whether you went to examination confidently or not. If you go to examination confidently, definitely you will pass in that examination. But how can we get confidence? You will get confidence only if you have done enough practice. At least 2 to 3 times revision should be there. You should have done model test papers, mock test papers and RTPs. Then only you will get confidence. Jayesh is saying, no, you wrong, sir. I did not understand, Jayesh. What are you saying? Hello, Jayesh. Are you there? So now we will discuss descriptive questions. Sheetal Limited is a listed company located in Mumbai. It is engaged in multiple activities at different locations. Books of accounts are Books of accounts are maintained by each unit separately. Head office maintains books relating to common transactions. All accounts are consolidated and return of income is filed at Mumbai. So the thing is, uh, in Mumbai, head office is there, branch offices are there across India. But whatever the books of accounts relating to branch offices are there, they can be maintained, they are maintained at respective branch offices. Okay. The following information is furnished unit-wise for the year ended 31st March 2025. Chemical Manufacturing Unit Jaipur, the company has reported net profit of 300 lakhs in books of accounts of the said business unit. It entered into an agreement for use of know-how owned by a renowned scientist. The amount of royalty paid during the previous year was 40 lakhs. The company deducted tax at source on amounts paid up to November 24 and omitted to deduct tax at source on 10 lakh rupees. See, total royalty 40 lakhs is paid, on the TDS is deducted. Second time, royalty 10 lakhs was paid, but on the 10 lakhs, no TDS was deducted. 10 lakhs into 30%, 3 lakh rupees will be disallowed. So if at the time of payment of royalty, if TDS is not deducted, 30% of the expenditure will be disallowed under section 40A1. Okay. Next. The payee admitted the royalty income fully, paid tax and filed return of income before due date under section 139(1). The company paid 1 crore 68 lakhs being 15% of basic salary plus DA to employees in notified pension scheme. See, employer contribution to notified pension scheme allowed only up to 14%. Here how much was paid? 15% was paid. Out of 15%, 14% is allowed as deduction to employer. 1% is to be disallowed. How much is 1%? 1% means 168 lakhs is for 15%. How much is for 1%? 11 lakh 20,000. So 11 lakh 20,000 will not be allowed as deduction. It is to be disallowed. Next, furniture manufacturing unit Pune. The company has a manufacturing unit at Pune. It reports a net profit of 90 lakhs as per books of accounts of the unit. It bought a trademark from Mr. Ello for rupees 25 lakhs on 1st June 2024, which is charged as expenditure in books of accounts. See, trademark is a intangible asset. It should be capitalized and it should be amortized. Depreciation will be provided 25%. However, here entire expenditure was charged to P&L account. Is it correct? No, that is to be disallowed. However, 25% depreciation will be allowed as deduction. Jesh, what you are saying, I am not understanding. Next, unit paid 3 lakhs as interest on loan taken from a non-resident Indian. The tax was deducted at source, but it was remitted only on 6th May. See, loan taken from non-resident, interest paid to non-resident. Whatever the interest paid to non-resident is there, on such interest, TDS is required to be deducted before 31st March. Deducted TDS is required to be deposited before ITR due date. In this question, TDS was deducted in March. Before 31st March only TDS was deducted. But it was deposited on 6th May. 6th May means before ITR due date. Na? So as TDS was paid before ITR due date, so expenditure is allowed as deduction. 3 lakhs is allowed. It is not to be disallowed. Next. Company paid 7 lakh rupees being amount of income tax payable by the employees as non-monetary perquisites provided by the company. See, tax on non-monetary perquisites. Whatever tax on non-monetary perquisites is there, tax on non-monetary perquisites is not allowed as deduction to employer. It is income to employee, but that income is exempt to employee under section 1010 CC. Okay, so here whatever 7 lakh rupees tax paid by employer on non-monetary perquisites to employee is there, that is not allowed as deduction. That is to be allowed. Next, fertilizer producing unit, Narmada. The company established a fertilizer producing unit in Narmada, Gujarat, which became operational in July 2024. So, fertilizer producing unit, this is eligible for deduction under section 35 AD na. Fertilizer, see, there are 14 businesses covered under section 35 AD, specified businesses. One of the specified business is fertilizer manufacturing unit. The fertilizer manufacturing unit is eligible for deduction under section 35 AD. So, under section 35 AD, you can claim revenue expenditure as deduction. You can also claim capital expenditure as deduction, but you cannot claim land as deduction, land expenditure. You cannot claim financial assets, and you cannot claim intangible assets, goodwill. Okay, goodwill, financial assets, and land. These three assets expenditure is not allowed as deduction under section 35 AD. Now, he acquired land for 1 crore. Is it allowed as deduction under section 35 AD? No. Okay. Next. He acquired a building for 2.5 crores. This is allowed as deduction under section 35 AD. New plant and machinery for 3 crores. That is also allowed as deduction under section 35 AD. Net profit as per books of accounts was given 220 lakh rupees. So, net profit is given. From that you will claim deduction under section 35 AD. After deducting depreciation, see, once you claim deduction under section 35 AD, you should not claim depreciation. Here net profit is after reducing depreciation. Now, depreciation is to be added back. Okay, net profit before depreciation. You have to arrive at net profit before depreciation. From that you can claim deduction under section 35 AD, because once you claim deduction under section 35 AD, again depreciation deduction is not allowed. Okay. Warehousing facility for storage of edible oils. If warehousing facility is for storage of agricultural produce, then 35 AD deduction is available. Here it is not for agricultural produce, it is for edible oils. So deduction under section 35 AD is not available. Okay. It established a warehousing facility for storage of edible oils on 1st August 2024. It made investments such as cost of land 2 crores. See, 35 AD deduction is not available, and land is also not a depreciable asset. You cannot claim depreciation. Building 3 crore rupees, you can claim depreciation at the rate of 10%. Plant and machinery 5 crores, you can claim depreciation at the rate of 15%. Okay. So for every branch, you will take net profit, you will do adjustments. Generally, what will we do? Normally, he will give total P&L account. Here he did not give total P&L account. Here he gave net profit for each branch. For each branch, some adjustments were given. So what will we do? We will take net profit for each branch. We will do adjustments. We will add net profit of all branches. Thereby, we are going to arrive at the total income. Are you able to understand? Next. Company mobilized capital during previous year 24-25 by public issue of shares. The application money was kept in bank pending allotment of shares. The interest income from the said deposit was 3,20,000 is credited to general reserve. Very, very important. Monish and Surendra, please listen. 3,20,000, it is interest income. Why interest income was received? Share application money is deposited in bank. For depositing share application money, we received interest income. See, share application money is of capital nature, na? So whatever the interest income received on income deposited in capital nature, that is not allowed as expenditure in P&L account. This 3,20,000 rupees, it is income for deposit of share application money. Tomorrow there will be share issue expenses na, from share issue expenses you can reduce income from interest income from share application money deposit. Let's say tomorrow for issuing shares I incurred 10 lakh rupees expenditure. From 10 lakh rupees expenditure I will claim 3,20,000 as deduction. So whatever the income received 3,20,000 is there, that can be reduced from share issue expenses. Okay, that should not be debited to P&L account. Company declared interim dividend of 10% of share capital being 40 lakhs in December 2024. It has 27% shareholding in ABC. New York, from it received 56 lakhs as dividend in February 2025. Both dividend received and paid were credited and debited respectively in consolidated statement of P&L account. See, intercorporate dividend. Whatever intercorporate dividend received is there, from that you can claim deduction. How much you can claim deduction? Whatever the dividend that you have received, you will redistribute it to shareholders, right? How much you redistributed to shareholders before 1 month before ITR due date, that much dividend will be allowed as deduction. Next, total turnover 22-23, 390 crores. So in 22-23, turnover is less than 400 crores. So tax rate for 24-25 will be 25%. And in 23-24, 405 crores. The company has MAT credit of 20 lakhs. Book profit computed. Compute total income of the company and optimum income tax liability for assessment year 25-26. Assume company have not opted for concessional tax regime. That means company is paying taxes under optional tax rates only. Sorry, company is paying taxes under regular tax rates. Company did not choose 115 BAA or BAB. Your answer must give reasons for treatment of each item given. Optimum income tax. Optimum income tax means what? First, we will calculate taxes under normal provisions. Then we will also calculate taxes under 115 BAA. Wherever tax is low, there that option we are going to choose. Are you able to understand? So I explained you all the adjustments. You can go through the calculation. Answer is given in the material. Next, shall we discuss question number 2? ABC Private Limited was converted into LLP. As ABC LLP on 1st October 2024, you are provided with following particulars of ABC Private Limited as on 31st March 2020. Just give me 1 second. You are provided with following particulars of ABC Private Limited as on 31st March 2024. See, whenever there is conversion, private limited company is getting converted into LLP. Certain important points are there. Some conditions are there. All assets and liabilities are to be transferred. 50% of the shareholders should become uh, shareholders of LLP. So if all these conditions are satisfied, whatever the losses of company are there, losses will be carried forward to LLP and fresh time limit of 8 years is available for carry forward. Okay. Business loss 54 lakhs. See, whatever the business loss is there, that business loss can be carried forward to LLP if all the conditions are satisfied. Are you able to understand? Written down value of assets as per Income Tax Act. See, when conversion took place, Conversion took place on 1st October 2024. So if conversion takes place in the middle of the year, what will we do? We will calculate depreciation for whole year for private limited company. Whatever the depreciation for whole year is there, that is to be apportioned between private limited company and LLP based on number of days of usage. Are you able to understand? So when conversion took place on 1st October 2024, conversion took place. That means before 1st October 24, private limited company, on or after 1st October 2024, LLP. So how many days assets are used by private limited company? April 30 days, May 31, June 30, July 31, August 31, September 30. 183 days are used by private limited company, and 365 minus 183, 182 days are used by LLP. Okay, so what will we do? Here there is conversion in the middle of the year. We will assume used asset is used by one entity only. We will calculate depreciation for whole year. Whatever depreciation for whole year is there, that is to be apportioned between company and LLP based on the ratio of 183 is to 182. Okay, now I will show in the answer also. You can see it was allocated to LLP on 182 days basis, and it was allocated to and it will be allocated to company in the ratio of 183 days. Okay. So what will you do? You will take written down value in the books of private limited company. You will apportion the depreciation. After apportioning the depreciation, whatever the balance written down value is there, the balance written down value will continue with the LLP. Are you able to understand? Business loss of 54 lakhs. I already told you, losses of private limited company will be carried forwarded to LLP if all the conditions are satisfied, and fresh time limit of 8 years is eligible for carry forward. Do you remember? Third point, cost of land. See, land is a non-depreciable asset. So whenever land is transferred from private limited company to uh, LLP, it will be transferred at book value. Fair market value will not be considered. So how much is book value? 80 lakhs. So in hands of LLP, cost of land is equal to book value in the hands of private limited company, which is nothing but 80 lakhs. Expenditure on voluntary retirement incurred by company during 22-23 is 28 lakh rupees. Voluntary retirement expenditure. See, you know voluntary retirement expenditure na VRS expenditure. How much is VRS expenditure? VRS expenditure is 28 lakhs. It is allowed as deduction over a period of 5 years. So 28 lakhs divided by 5. Every year 5.6 lakhs will be allowed as deduction starting from 22-23. 5.6 lakhs in 22-23. 5.6 lakhs in 23-24. 5.6 lakhs in 24-25. 5.6 lakhs in 25-26. 5.6 lakhs in 26-27. Now, private limited company is in existence only in 22-23. Okay. So for private limited company, it is allowed as deduction. In 24-25, private limited company is getting converted into LLP na. So from 24-25 onwards, whatever VRS expenditure of private limited company is there, that can be claimed as deduction by LLP. Are you able to understand? Unadjusted MAT credit. I don't think MAT credit can be carried forwarded to LLP. At the time of conversion of private limited company to LLP, MAT credit will not be carried forward. Logical. For LLP, AMT provisions are applicable. MAT provisions are not applicable. That's why MAT credit cannot be carried forwarded to LLP. You can see this point. MAT credit in case of conversion of company to LLP credit of MAT cannot be availed by successor LLP. Okay. Unabsorbed depreciation can be carried forwarded to LLP, not a problem at all. Next, question B. Mr. Mani Prasad, aged 71 years, furnished following information in respect of income earned by him for previous year ended 31st March 2025. So what are the incomes? Pension from state government. This is taxable under salaries. See, whatever the pension income is there, from pension income, you can claim standard deduction. Under default tax rates, you can claim standard deduction 75,000. Under optional tax rates, you can claim standard deduction 50,000. Correct? Next, short-term capital gain on sale of plot. Deposit in PPF. This is eligible for deduction under section 80C. Speculative income. This is business income. Okay. Next, country M, agricultural income. See, agricultural income from country M. Foreign agricultural income is taxable under income from other sources. Okay. Next, dividend from a company incorporated in country M, exempt in country M. Even though dividend is exempt in country M, it is taxable under income from other sources. Next, country N, business loss, proprietary business, not eligible for set off against other incomes in country N. See, business loss is not eligible for set off in country N. But when we are calculating income in India, whatever the business loss is there, that is eligible for set off. Gross rental income, careful. Here he did not give income from house property. That is not income from house property. It is rental income. Rental income means gross annual value. From that you should claim municipal taxes. You should claim standard deduction at the rate of 30% under section 24A. Thereby you will arrive at income from house property. So how much is 3,20,000 is rental income. From 3,20,000, if you reduce 30% standard deduction, how much? 2,24,000 is income from house property. Next, oh, I'm sorry. No, Surendra, we did wrong. Municipal taxes are given here. If you remember, why eraser is not working? Who said iPad will not hang? You can see iPad is hanging. This is latest iPad M4. So glitches are there even in iPad also. Municipal taxes are there. What is income from house property? 3,20,000. From this we will reduce municipal taxes. How much are municipal taxes? 21,000. Balance 2,99,000. Correct? We are. $3,20,000. From this we will reduce municipal taxes 21,000. 2,99,000. From this we will claim 30% standard deduction. 89,700. 2,09,300. That is income from house. There is no agreement. See, if there is no DTW agreement, then relief will be provided under section 91. We know, right? Step 1, we will calculate tax on total income. Step 2, what will we do? We will compare we will calculate average tax rate in India. Average tax rate in India should be compared with average tax rate in country M, whichever is lower we need to take. Then we will consider average tax rate in India, and we will also consider average tax rate in country N, whichever is lower we will take. Then what will we do? We will take doubly taxed income. On doubly taxed income, we will apply lower tax rate. Thereby, we are going to calculate relief under section 91. Correct? Actually, this is asked for 6 marks, very less. Many adjustments are there. Two countries' incomes are given, and he asked it only for 6 marks. And here it was given in country M, tax rate is 10%. In country N, tax rate is 5%. Are you able to understand? Now, I think you can do. First, you will calculate tax on total income, entire income. Then you will calculate average tax rate in India. Average tax rate in India must be compared with 10%, whichever is lower should be taken. Average tax rate in India must be compared with 5%, whichever is lower should be taken. Now, how much is doubly taxed income? Agricultural income, dividend income, both are taxable in India, na? So, for country M, doubly taxed income is equal to 86 plus 68, 1,54,000. For country N, how much is doubly taxed income? For country N, 2,09,300 is income. From that, you will set off this loss, na, 1,16,000. So, how much is doubly taxed income? 93,300. So, for country N, doubly taxed income is equal to 93,000. On doubly taxed income, you will apply lower tax rate. Thereby, you will calculate relief under section 91. Correct? So, here you can see 93,300. 93,000. In country M, see, we did one mistake here. In country M, agricultural income is there. That is taxable in India. Agricultural income is also taxable in country M. So it is doubly taxed income. But whatever dividend from company incorporated in country M is there, it is exempt in country M and taxable in India. So it is not doubly taxed. It is exempt in country M and taxable only in India. So it is not doubly taxed income. So 1,54,000 is not doubly taxed income. 86,000 is doubly taxed income. 68,000 is not doubly taxed income. So here doubly taxed income is 86,000. So you please go through the calculation. You will understand. I explained you all the adjustments. Okay. Next question number 3. Sir, out of topic doubt in DTWA, royalty income is to be taken in PGBP or IFOS. See, if he is author, if his main business is writing books, then whatever the royalty income is there, it will be treated as business income. Or else, if their main business, if they are not extremely into writing books, then if they write books passively, then royalty income is taxable under IFOS. You know, Sudha Murthy, she is a director in Infosys. She also writes books. Now, part-time, that means she has some passion towards writing books. She is writing books. From writing books, she receives royalty income. But her main work is she is director of Infosys. Now, Sudha Murthy, if she receives any royalty income, it is taxable to her under income from other source. Chetan Bhagat is there. His main profession is writing books. He is author. Okay, if Chetan Bhagat receives any royalty income, it is taxable to him under PGB. Did you understand? Next question number 3. How much time each question is? Apre. Examine following based on relevant provisions of Income Tax Act 1961 and Judicial Pronoun. Satvik Public Charitable Trust sold one of its buildings, which was held by it for charitable purpose, for 4.2 lakhs on 28th September 2024. The asset were acquired on 25th June 2022 for 2.2 lakhs. It invested 3 lakhs in fixed deposits for the tenure of 2 years. See, in case of trust, we will calculate capital gains normally only. But if any reinvestment is made, reinvestment is eligible for exemption. Sir, how much reinvestment is eligible for exemption? If total net consideration is reinvested, total capital gain is exempt. If part of the net consideration is reinvested, then exemption is equal to cost of new asset minus cost of old asset. Here, how much is sale value? It was sold for 4.2 lakhs. Are there any transfer expenses? No. Net consideration is 4.2 lakhs. Correct? Now, can we claim exemption? Yes. If amount is reinvested, you can claim exemption. How much is reinvested? 3 lakhs is invested in fixed deposit for tenure of 2 years. That means what? 3 lakhs it presently deposited in safe modes under section 11.5, and with that money it will purchase another asset. Now, can it claim exemption? Whether total 4.2 lakhs is reinvested or deposited in fixed deposit? No, only 3 lakhs is reinvested. Now, how much is exemption? Exemption is equal to cost of new asset minus cost of old asset. How much is cost of new asset? Cost of new asset is or reinvestment is 3 lakhs. Cost of old asset is 2.2 lakhs. 3 lakhs minus 2.2 lakhs. How much? 80,000. So, net consideration is 4.2 lakhs. From this, we will claim cost. Cost is 2.2 lakhs. How much is capital gain? Capital gain is 2 lakhs. From this capital gain, exemption is equal to 3 lakh minus 2.2 lakh. How much? 80,000. 0.8 lakhs is exemption. How much is taxable capital gain? Taxable capital gain is 0.2 lakhs. You can see the answer also. 1,20,000 is taxable in the hands of trust. Very simple. I will tell the logic also. Already 2,20,000 is treated as applied na. Already 2,20,000 is treated as applied in earlier years. Now how much is reinvested? 3 lakhs is reinvested. Correct? So already 2,20,000 was whatever the original cost of acquisition, that is already allowed as deduction in earlier years. Now actually amount reinvested is 3 lakhs. 3 lakhs should be allowed as deduction. But already you claimed 2,20,000 as deduction here na. So that's why only 80,000 will be allowed as exemption. If you understand logic, okay. If you do not understand the logic, then exemption, especially in case of trust taxation, capital gain exemption is equal to cost of new asset minus cost of old asset. Okay. Next, second point, XYZ is an helpage, a trust established for the purpose of religious and charitable purposes. It runs a temple and a school. During year 24-25, it received anonymous donations amounting to 3 crores per temple, 8 crores per school. See, if anonymous donations are received by temple, religious trust, then section 115 BBE, it is not applicable. However, if anonymous donations are received by charitable trust, then section 115 BBE is applicable. Like anonymous donations are taxable at the rate of 30%. Are you able to understand? But deduction is allowed. 5% of total donations or 1 lakh, whichever is higher, will be allowed as deduction. Balance is taxable at the rate of 30%. Merces XYZ Electoral Trust incorporated in the year 2022 provides following information to you in respect of its transactions for 24-25. Total voluntary contributions received 420 lakhs, surplus brought from earlier previous year 18 lakhs. See, Electoral Trust, what it will do, it will take money from public. Whatever the money taken from public is there, that money will be distributed to political parties. There is one rule. Whatever the donations received by electoral trust is there, out of those donations, minimum 95% of the donation should be given to political parties. Not only donations received from earlier year, if any surplus is received, donation plus surplus, these two together, whatever the amount is there, out of that amount 95% should be given as donation to political party. Then only income of electoral trust is exempt, otherwise it is taxable. Now how much is donations received? 420 lakhs. How much is brought forward amount from earlier years? 18 lakhs. Total 438 lakhs. 438 lakhs into 95%, how much? 416.1 lakhs. So electoral trust is required to deposit is required to give donation of 416.1 lakhs to political party. Then only income of electoral trust it is exempt, otherwise it is taxable. Trax and Co is engaged in providing scientific research services to several non-resident clients. Such services are also provided to Olive Inc., which guarantees 12% of the total loans to Trax and Co. Examine whether transfer pricing provisions gets attracted. See, Trax and Co is there. Trax and Co. It is basically Indian company or Indian entity. It provides scientific research to Olive Inc. Olive Inc., let's say it is in USA, for example. Now it provides scientific research services to Olive Inc. Whatever the borrowings of Trax and Co., out of these borrowings, 12% are guaranteed by Olive Inc. Now, can we tell if more than 10% of borrowings are guaranteed by entity outside India, we can tell Trax and Co and Olive Inc. as associated enterprises, correct? So Trax and Co, Olive Inc. both will be treated as associated enterprise, and it is whatever the scientific research services provided to non-resident is there, they will be considered as international transactions, and transfer pricing provisions are applicable here. Are you able to understand? TP provisions are applicable. Next, without prejudice to answer to one above, assume that transfer pricing provisions are attracted in this case, and the assessing officer has made primary adjustment of 310 lakhs to transfer price in 23-24 by order dated 31st March 2025, and the same was accepted by Trax and Co. What are the consequent requirements? See, whatever primary adjustment is there, primary adjustment is 310 lakhs. SSC accepted the primary adjustment. So from date of acceptance, within next 90 days, 310 lakh rupees is to be brought into India. If 310 lakh rupees is not brought into India, it will be deemed as loan given to associated enterprise, and every year interest income will be calculated. Such interest income will be included in the total income of the SSC, which we discussed in TP provisions. Assume the transaction is denominated in Indian rupees and no amount has been repatriated till 31st March 2026. Actually, within 90 days, money should be brought into India, but no money was brought into India within 90 days. Now, what is the consequence? Every year, interest income will be calculated till the time that amount is repatriated to India. Here, SBI marginal cost of lending rate is 9%. What is the rate of interest? Interest rate is equal to SBI rate plus 3.25% as transaction is denominated in Indian currency. SBI rate 9% plus 3.25%. How much? 12.25%. So how much will be interest income? Interest income is equal to 310 lakhs into 12.25%. It's not 12.5, 12.25. We can cross check also. 12.25. Okay. And interest income is 37 lakh 97,500. 310 lakhs into 12.25%, 37 lakh 97,000. Sir, is there any alternative available? Yes, alternative is available. If company don't want to bring that money into India, if it don't want to repatriate to India, it should pay one-time tax. How much is one-time tax? 20.944%. 18% tax plus 12% surcharge plus 4% HEC, 20.9664%. It needs to pay one-time tax. You can see 20.9664%. Base tax 18%, surcharge 12%, HEC 4%. So this question is relating to secondary adjustment. In transfer pricing provisions, they are asking secondary adjustment. They are also asking limitation of benefit for interest expense. These 2 points are being tested. Okay. Shall we discuss fourth one? Next, Marigold Limited, an Indian company engaged in trading of electric appliances through retail stores all across India, reported a total turnover of 70 crores during previous year 23-24 and 45 crores during the previous year 24-25. The customers who purchase appliances from its stores can only pay through cash, check, credit or debit card. Discuss the relevant provisions of the Act with respect to relevant compliances. See, there is one section called 269 SU. As per section 269 SU, UPI mode of payment, debit card, credit card mode of payment are to be provided. If debit card, credit card mode is not provided, UPI mode is not provided, then penalty will be levied. Penalty is 5,000 rupees per day. But no penalty is levied. Penalty will not be levied. When penalty is not levied, if SSC shows sufficient reason, then penalty will not be levied. Otherwise, penalty will be levied 5,000 rupees per day. So, as per section 269 SU, every business whose turnover is more than 50 crore rupees, it is mandatorily required to provide mode of payment of debit cards, credit cards, unified payments interface. Otherwise, penalty of 5,000 rupees per day will be. An Indian company pays gross salary including allowances and monetary perquisites amounting to 7,30,000 to its general manager. Besides, company also provides non-monetary perquisites to him whose value is estimated at 1,20,000. General manager has not given any declaration regarding opting out of section 115 BAC. Examine liability for tax deduction at source in the hands of Indian company. So very simple. In case of salary, we will calculate average tax rate. TDS will be deducted at average rate of tax. So income is 7,30,000, 1,20,000. Total 8,50,000. On 8,50,000, you can claim standard deduction na 50,000. Correct? It will be 8 lakhs. So on this 8 lakh rupees, tax will be collected. Did he say under default tax rates? Okay. See, generally, employee should give declaration to employer. If employee do not give declaration to employer, employer will deduct under default tax rate. Okay, only if employee gives declaration to deduct TDS under optional tax rates, then only employer will deduct TDS at optional tax rates. So here, as no declaration is received, we can assume TDS is to be deducted under default tax rates, 75,000 standard deduction, balance 7 lakhs 75,000 is only taxable. On 7,75,000, how much is tax liability? 28,600. Whatever 28,600 is there, that will be divided into 12 months. How much? 28,600 divided by 12 months, 2,383.3. That will be deducted as TDS over a period of 12 months. Are you able to understand? So the company can deduct 28,000. XYZ company, an Indian company, is engaged in business of manufacturing of packaging material, having its manufacturing facility in India. XYZ and Co is wholly owned subsidiary of Flix Inc, a company incorporated in country M. So there is XYZ and Co. It's a company in India. Its parent company is Flix. It is incorporated in country M. Okay. Angelo and James, citizens and residents of country N, each of them hold 50% share capital of Flix Inc. So there are two shareholders, Angelo, James, Angelo, James. Both of them hold 50% shareholding in Flix company, but both of them belong to country N. Okay. Each of them holds 50% share. Each had invested equivalent to 100 crores in Flix Inc. in April 2015. On 1st June 2024, Angelo and James, having received an offer which they believe was fair, sold their entire stake in Flix Inc. to Ishan, resident of country N, for an amount of 350 crores each. See, normally how much they invested? Each invested 100 crores. James invested 100 crores, Angelo invested 100 crores. They invested in Flix Inc. Flix Inc. has its shares in XYZ and Co. Now they received offer. Whatever their shareholding is there, they sold their shareholding for 350 crores. This 100 crore shareholding was sold for 350 crores. Okay. See, they are not transferring Indian company shares. They are transferring foreign company shares. Are they transferring XYZ and Co shares? No, they are transferring Flix Inc Limited shares. Now, because of transfer of Flix Inc shares, indirectly shares of XYZ and Co are also transferred. Now, transfer of shares of Flix Inc, whether it is taxable in India or not. The provision is whenever shares of foreign company are transferred, it will be deemed that shares of foreign company transfer is taxable in India if two conditions are satisfied. First condition, assets in Indian company should be more than 10 crores and whatever the assets of Indian company are there, assets of Indian company should be greater than 50% of assets of foreign company. If these two conditions are satisfied, then even though if these two conditions are satisfied, sufficient, whenever these two conditions are satisfied, even though foreign company shares are transferred, it will be assumed that those such transfer of foreign company shares is taxable in India. Okay. Now, the accounting period of Flix Inc is January to December. The relevant extract of balance sheet of Flix Inc as on 31st December 23, 1st June 24 and 31st December 24. We need to take date of transfer. What is date of transfer? 1st June 2024. So as on 1st June 2024, how much is investment in Indian company? Fair market value of assets of XYZ and Co is 600 crores. So assets in India are 600 crores. That means more than 10 crores. Condition 1 satisfied. Correct. Condition 2, assets in India, like whatever the assets in India are there, they should be more than 50% of assets in foreign company. Assets in India are 600 crores. Assets in foreign company are 1100 crores. Fair market value. Now, assets in India are 600 crores. Assets in foreign company 1100 crores. 50% of 1100 crores means 550 crores, correct? So 50% of assets of foreign company 550 crores. Assets in Indian company are greater than, like assets in Indian company are greater than 50% of assets of foreign company. In this case, both the conditions are satisfied. As both the conditions are satisfied, even though foreign company shares are transferred, still the transaction is taxable in India and tax is required to be paid in India. Are you able to understand? You can go through the answer also. Two conditions: exceeds 10 crores, at least 50% of value of all assets. 600 crores, which is more than 10 crores. It is 50% of 54.5, more than 50%. Na? So hence shares of Flix Inc would be deemed to be a capital asset situated in India, and capital gains from transfer of shares of Flix Inc by Angelo and James would be deemed to accrue or arise in India. Now, shall we discuss the next question? Question 5. See, in every model test paper, question 5, he is giving 3 cases. We need to answer more or less in a theoretical way. First, we will write provision, then we will write analysis, then we will write conclusion. In that way, he is expecting the answer any two of the. Wow, I don't know why iPad is behaving like this. Answer any two of the following 3 cases. First case, during scrutiny assessment of Orange Limited, a company engaged in managing and manufacture and distribution of packaged coconut water and fresh drinks. The assessing officer increased the income passed an order of demand. Aggrieved by the order, SSC filed an appeal to CIT Appeals, who confirmed the order of assessing officer. The SSC further appealed before ITAT requesting for stay of collection, which the tribunal provides initially for 180 days on deposit of 20% of amount of tax by Orange Limited. Thereafter, bench was functioning intermittently, and therefore the disputed matter could not be disposed of. The company applied for extension of stay and was granted extension up to 365 days. ITED did not dispose of the appeal before time extended for collection of tax. The revenue served an order of demand citing the reason that the order of stay automatically gets vacated post expiry of 365 days. What is issue here? Whenever department appealed to ITET, department will also give me demand order. I need to make payment. What I will do? I will go to ITET. I will get a stay from ITET. I will pay 20% of the tax. I will get stay for 180 days. Within 180 days, if case is not disposed of, I will request for extension. Then income tax appellate tribunal will give extension to me till 365 days. After 365 days, if case is not disposed of, then department can recover tax from me. Are you able to understand? But there is one Supreme Court judgment. As per that Supreme Court judgment, even after 365 days also, if case is not disposed of by ITAT, till the stay will continue, stay will not be vacated. Are you able to understand? Even after completion of 365 days also, stay will continue and stay will not be vacated, subject to the condition there should be no default on part of the SSC. If there is no default on part of the SSC, stay will continue even after 365 days also. Let's say SSC is going to hearing whenever ITAT calls. SSC is coming, but ITAT, because of having so many cases, ITAT could not dispose of. Now, this is not the problem of the SSC. There is no default of the SSC. If there is no default of the SSC, in that case, stay will not be vacated. Stay will continue even after 365 days. Also. Are you able to understand? Sir, how to write answer for this type of question? So, I have prepared one thing. So, you can see here, whenever you get this type of question, you can write in simple words. Issue. Can a stay order will be automatically vacated after 365 days or not? That is the question. Next, analysis. Law. You can write the provision section number. If you do not remember the section number, you can write as per provisions of Income Tax Act. Okay. So as per provisions of Income Tax Act, stay that will stand vacated after 365 days, even if delay in appeal is not attributable to SSC. So this results in automatic vacation of stay after 365 days. Causes hardship to SSC if delay is due to department or tribunal. Stay order should vacate only if delay in disposal is attributable to SSC. See, as per Income Tax Act, after 365 days, whatever the stay given, it gets vacated. But as per Supreme Court judgment, even after 365 days also, the stay will continue subject to the condition there should not be any default on part of the SSC. So we will write 2 points. As per Income Tax Act, as per section 254, after 365 days, stay will get vacated. But as per Supreme Court judgment, stay will continue even after 365 days also if there is no default on part of the SSC. So we need to consider latest one Supreme Court judgment. Okay, that we will write as conclusion. Now, shall we see question 2? The assessment of Mr. Sharma was completed under section 143(3) of Income Tax Act 1961 with an addition of income of 8.5 lakhs. Mr. Sharma contends that order of assessment is bad in law as no notice was issued under 143(2). See, I will tell you this case. You know scrutiny assessment, right? Before doing scrutiny assessment, department needs to issue notice under section 143(2). Then department, after issuing notice, then department will do scrutiny assessment under section 143(3). Correct? Now, whenever, like here in this case, department did not give scrutiny assessment notice. Department directly did scrutiny assessment. Is it correct? That is not correct. Scrutiny notice should be issued only after issue of scrutiny notice, then only assessment should be completed. But client does not know about this. Department did not do scrutiny, did not give scrutiny assessment notice. Department directly did scrutiny assessment. SSC, he is not aware na. He cooperated in the proceedings and AO passed the assessment order. Now, whether this assessment order is correct or not, this assessment order is not correct because no notice is issued by Income Tax Department under section 143(2). Are you able to understand? I will tell another point if you are interested. Notice given by Income Tax Department, but whatever notice given under 143(2) is there, that is time barred. That means that notice was received after expiry of time limit. Then if SSC has cooperated in the assessment and assessment order is passed, then that assessment order is valid because at least department gave notice and then did the assessment, then and SSC cooperated in the assessment proceedings unaware that it is time barred, then that assessment order is valid. But without giving notice, if assessment is completed and SSC cooperated, that assessment order is not valid. Minimum notice should be given. Only after giving notice, assessment should be done, then only that assessment order is valid. Even though notice is given lately, still assessment order passed is valid. But if notice is not given, then assessment order passed will not be valid. Are you able to understand? Fast Construction Private Limited is engaged in construction of bridges and flyovers. During previous year 24-25, it made payment to various parties and deducted tax amounting to 18 lakhs. However, company failed to deposit the said amount with Income Tax Department within the time prescribed. So, company deducted TDS. Deducted TDS is not deposited to department within the time limit. Okay. Now, the company submitted that it is facing financial hardship since a large sum of money has been stuck up with its debtors and also with Income Tax Department in the form of refund. Why company did not pay TDS? Because lot of money is there with debtors. That means the company is suffering financial crunch. See, in books money is there, but in bank account money is not there because most of the money got stuck with debtors and most of the money got stuck with refund from Income Tax Department. So that's why company could not pay TDS within the time. It is further submitted that in spite of financial crisis, company has suo motu deposited TDS amount along with interest under section 2011A before receiving any notice from income tax department in this regard. However, prosecution proceedings were initiated. See, I am not having money. Till even department gives notice, even before department gives notice to me, on myself, voluntarily I deposited TDS amount to government even before department issues notice. Now, see, I did not pay within due date, but I paid after due date even before notice is given by income tax department. Now, in this case, prosecution proceedings cannot be initiated. Prosecution proceedings will be initiated only if SSC do not pay TDS, then only prosecution proceedings will be initiated. Here SSC paid TDS even before notice has come, so prosecution proceedings will not be initiated. Okay. Next, this is theory question. You can read on your own. Question number 6. Critically examine following cases and discuss whether provisions of GAR. Surendra, you asked me GAR. I will explain now. Listen. I can understand you are feeling very hungry. Give me 10 minutes. We will close. Critically examine following cases. Okay. Shiva Limited, an Indian company, has two manufacturing units. Unit X in special economic zone, Unit Y in non-special economic zone. So Unit X is in CES, Unit Y is in non-special economic zone, non-CES. Manufacturing activities are carried out in Unit Y, while Unit X only does the packaging of the goods manufactured by Unit Y in its books of accounts. It shows the manufacturing to be carried out in Unit X and claims allowable deduction. Now what is happening? All manufacture happens here. Here only packaging happens. See, this is actual. But how it is shown in income tax books? It is shown in income tax books. Entire manufacturing happens in CES unit. See, actually what is happening? Entire manufacturing is happening in non-CES area. Only packaging is happening is in CES and it is exported from CES. That is actual thing. But it is misrepresented. How it is misrepresented? It was misrepresented that entire manufacturing is happening in CES area so that extra deduction can be claimed. That's what, na? So this is case of misrepresentation of facts. Whatever the fact is there, SSE is twisting the fact and he is presenting different fact. Okay. So misrepresentation of facts means tax evasion. Whenever tax evasion is there, GAR provisions are not applicable. Only in case of tax avoidance, GAR provisions are applicable. So whenever you get this question, how to write in examination? First you will write what tax avoidance means. Next you will write what tax evasion means. Tax avoidance means what? Legally you are using the provisions of law, but you are misutilizing the intention of the law. Okay, it is like you are following the rules in substance, but you are following the rules as per law, but in substance you are not paying taxes. So that we call as tax avoidance. Tax evasion means what? You are falsifying expenses, you are falsifying income, you are falsifying revenue, you are doing misrepresentation of facts. That is called as tax evasion. In case of tax evasion, GAR provisions are not applicable. GAR provisions are applicable only if there is tax avoidance. That means what? Legally you are correct, but morally you are not correct. That is tax avoidance. Here legally also it is not correct. Na expenses of non-cess area, how can you show as expenses of cess area? That is not correct. It is misrepresentation of facts. Legally also not correct. Tax avoidance means legally correct, morally not correct. Here legally also it is not correct. Na. So this is case of tax evasion. In case of tax evasion, GAR provisions are not applicable. You can write the answer like that. You will write what tax evasion, 2-3 lines. You will write what tax avoidance, 2-3 lines. You can write this is the case of purely tax evasion, misrepresentation of facts. So in this case, GAR provisions are not applicable as it is tax evasion. So as per normal provisions, action will be taken. GAR provisions will be invoked only when there is tax avoidance. Are you able to understand? Surendra, did you understand? Next. Vishnu Limited, an Indian company, has two manufacturing units, Unit M in SEZ, Unit N in non-special economic zone. It transfers goods manufactured by Unit N to Unit M at a price significantly lower than market value. So, CES unit is there, non-CES unit is there. Okay. Now, CES unit is manufacturing goods. Sorry. Goods are manufactured by non-CES unit. So, non-CES unit is manufacturing goods. All these goods are transferred to CES at a lower price. Why it is transferred at a lower price? Because whenever it is transferred at lower price, lower profits will be there, lower tax can be paid. So here goods are transferred at lower price. Na. For this already see this transaction we call as specified domestic transaction. Even for specified domestic transaction also transfer pricing provisions are applicable. This is a case of tax avoidance. Genuinely he is doing the manufacture, but he is levying lower profit in non-cess area and higher profit in cess area, because if there is higher profit in cess area, total profit they can claim as deduction under section 10AA. So legally he is correct. He did manufacturing only in non-cess unit, but while transferring he added low margin. Whatever profit margin is there na, that is at the decision of the SSC. So legally he is correct, but morally intentionally he wanted to show lower prices. So this is a case of tax avoidance. Even though it is case of tax avoidance, already this issue was already dealt in transfer pricing. So specific anti-avoidance rules are already applicable here. As already specific anti-avoidance rules are applicable here, again GAR provisions will not be invoked. Are you able to understand? So whenever there is a specified domestic transaction, here also we will apply transfer pricing provisions. We will calculate arm's length price. Accordingly only goods will be sold to CES unit. Are you able to understand? So here what will we write? Here SSE is transferring goods from non-CES unit to CES unit at a lower price. Legally he is correct because fixing profit margin is the decision of the SSE. He is fixing lower margin in non-CES unit and higher margin in CES unit so that he can claim deduction under section 10AA. So this is a case of tax avoidance, but this case is already dealt in specific anti-avoidance rules, SAR rules. So thereby GAR provisions are not applicable. In this way, in simple sentences, you can write the answer. Okay. If you see the answers, he will give very big explanation. That big explanation is for understanding. But while writing the answer, you can write in generic words in a similar way. Okay. Uh, So this is relating to deduction under section 80 JJAA. See, I am not reading the question because it's taking a lot of time, but I will explain to you. What happened? You know deduction under section 80 JJAA, right? So in case if business is required to get its books of accounts audited under section 44AB, it is eligible for deduction under section 80 JJAA. Generally, 80 JJAA deduction is available for additional employee cost. Now, for that additional employee cost, there are some rules. If salary emoluments paid to employee are less than 25,000, then only deduction under section 80 JJAA is available. Otherwise, 80 JJAA deduction is not available. What happened in this case? Emolument is 24,500. To this, transport allowance was given. Transport allowance how much? 3,500. What SSE says is transport allowance should not be included in calculation of emoluments. But as per section 80 JJAA, whatever the transport cost is there, that transport allowance is there, that is also to be included in calculation of deduction under section 80 JJAA. So whatever the contention of SSE is there, contention of SSE is not correct. And for claiming deduction under section 80 JJAA, chartered accountant certificate is to be taken. But chartered accountant gave wrong certificate here. Chartered accountant said that 3,500 is excluded while calculation of emoluments. So whenever chartered accountant gives wrong certificate, he is punishable as per Income Tax Act 1941. That is the concept relating to this. Okay. So I will also explain this case. Advance ruling was applied. Whenever they apply for advance ruling, whatever the decision given by board of advance ruling is there, the decision is against to the SSE. Now, if SSE is aggrieved by decision of board of advance ruling, SSE has an option. He can file appeal before High Court within 60 days. Are you able to understand? That is the concept relating to case C. You can read the answer, you will understand. So this is all about model test paper 2. I can understand it took a lot of time, but see, in this entire discussion, you came across many new points. Remember all those new points, write all those new points in one page, read all those new points before you go to examination. Okay, it gives super confidence to you. And with this concept, with all these new points that you have learned, definitely you can go to examination confidently and you will pass. Thank you, Monish. Thank you very much. I wanted to conduct this model test paper discussion in morning only because morning fresh mind I can explain to you. Evening I am getting exhausted, and moreover this is 100 marks paper, 114 marks paper. It is taking a lot of time. In the evening I am not having proper mood. So is it okay if I explain on a daily basis on morning? Because direct taxation, whatever this concept is there, if I explain in the evening, it is also tough for you to absorb the concept. Morning fresh mind you can easily absorb. Yeah, I also appreciate your efforts, Surendra, Varun and Monish. You three are very handy to me. Whenever I keep class, you are attending and you are obtaining the knowledge. Thanks a lot for your support. Let's conclude for today.